Our next guest is an amazing woman. She is an author and she is a speaker and she really is a journalist and has so much to say. Welcome back, if you would, Nomi Prins. Hey, Nomi.
Hi, how are you? Thank you so much.
Well, it's great to see you again. And you always have a lot to say on many of the topics that we are discussing today. And, you know, a couple of your books really focus on central banking. And as real estate investors, sometimes people put that to the side. They aren't as interested when we start talking about the Fed and monetary policy and printing, but it really does work its way through to the markets and affect real estate. So I think, you know, you've been talking for quite some time, and the last time we had you on the show, about just kind of the, we'll call it, I don't know if it's manipulation or false premise or what, the way that the bankers, the central bankers work. But maybe we'll start with that. And we have seen extraordinary money printing in the crisis. How is all that shaking out?
Well, you're right. We have seen tremendous and far greater, actually, than during the financial crisis of 2008, electronic money printing, not just from the Federal Reserve, but from all of the central banks around the world in trying to keep their liquidity, their credit markets, as they say, their economies, and whatever proportion that money goes to is a separate issue. But all of that sort of as up as possible, given the current pandemic and the crisis that has created, both from a health and financial, economic, and money standpoint. The Fed itself has printed electronically, or effectively grown its own balance sheet from what was $3.7 trillion last summer to $6.7 trillion now. I personally believe, given not just that trajectory, but why it's happening, which is trying to create that money, provide liquidity into the markets, keep rates at zero now, is that it's going to go to at least 10 trillion. Because, and this is kind of how it relates to real estate in two ways. One is obviously the cost of money to the banks, to the lenders, and therefore to anyone investing or refinancing real estate. And then also the purchasing of real estate securities that the banks have created, that the Fed has bought in the past for its book and has continued to buy during this period and will continue to buy for its books as well. And that's both regular properties, sort of individual properties, up through commercial real estate.
Yeah, and you see, I mean, I know that we've experienced that. We look back to the last downturn, which of course is completely different in many ways, but the response, maybe not so much. And there was the whole discussion back leading up to the 2008 meltdown that this liquidity would work its way into the market, to jobs, to so forth. And then the discussion about banks kind of hanging on to that. This time, a lot of the stimulus money has gone directly to people in terms of either unemployment or through the PPP program to businesses with the majority to pay workers. That's not really employment, but the money is kind of getting to the consumer. Does that make any difference?
It makes a difference to those consumers and then to those individuals that have lost their jobs, or particularly the small businesses who are trying to hold on to their piece of business America, right? And that's very much a component, a backbone of American economics. And it is a little bit more, and I say a little bit because there was some stimulus given to individuals, not so much small businesses, during the last financial crisis. And since then, the money that had been created by the Fed and the liquidity in the system predominantly didn't go to those small businesses to the same effect that it went to larger businesses. They didn't have the same access to that cheaper money. But now what's happened is, yes, there is a stimulus package. There's two, in fact, and there might be a third one, which has done things for the unemployed in terms of providing money. But, you know, we're still dealing with 30 million people who have filed for jobless claims in the first sort of 6 weeks of this crisis coming upon the American economy, and that's pushed unemployment levels for the first quarter up to significantly higher than they had been. And we could go to double digits. We could go to 10% to 14%, or even in the 20%, which is reminiscent of the Great Depression. So though there is money going into some of those individuals and some of the small businesses, a lot of people aren't getting enough. or are just effectively not having gotten anything from some of the loan programs. And hopefully there is a new Main Street lending program that the Federal Reserve has just opened that could help to buy the loans that the Small Business Association is giving to some of these individuals. But still, there will be a lot of people caught up, and that's going to have a real drag on the economy, even when and if it opens in parts and we see what a new normal actually could look like, balancing health and safety issues with economic issues. It's still going to take some time for real sort of spending to occur. And in fact, the savings rate right now of the American public over the last quarter, the latest data shows that it's over 13%. And it hasn't been that high since Reagan, since 1981. So people, when they can, are trying to save their liquidity rather than spend their liquidity because of how uncertain these times are.
That makes complete sense. And I think we've seen that happen. One of the things as landlords, if you will, especially residential real estate investors, is there are several places where people have lost their jobs. A lot of those people are tenants, so that affects their ability to pay rent. So that kind of works its way on down the line to mortgage companies having to, be gentle and all of that. But ultimately, all this printing does end up in the economy, right? So you brought up interest rates, which are key to real estate investors. It's kind of the thing we operate on. We're going to buy a property with leverage. So certainly, real estate investors of all shapes and sizes, and really everybody, but investors are considering what rates may be when they're making decisions. There are certainly the folks you talked about that are saving more, so they're maybe less likely to make purchases. People are indicating they're less likely to buy homes, and that's maybe obvious. But investors look at the other side. Does that mean there's opportunity? Will there be some bargains to pick up? Will there be some people that could be helped out? And on that side, what would you expect that long-term interest rates might look like coming out of this, recognizing that you don't have that crystal ball we'd all love to have?
Yeah, well, first of all, there's definitely opportunity as people unfortunately have to make decisions, even if they have some months of forgiveness or deferment of certain loan payments, in terms of whether they want to stay in their properties from a residential perspective, and also if they ultimately want to downsize, that they don't necessarily want as much leverage, or they want to refinance their leverage, but that gives opportunity to other people who have more access to leverage and access to funds. And right now, with rates where they are, for example, 30-year rate for a jumbo loan is about 3.125. It was a 3.5 a couple of weeks ago. I don't know that gets much lower than that. I truly believe that even though the Fed will keep rates at zero for literally the foreseeable future, and I'm talking 2-3 years. I mean, I don't see us getting out of this economic situation, the credit liquidity situation, the Fed raising rates literally anytime soon. So that's kind of just, in the future it might happen, but not now. But I think with the 10-year having sort of dipped into the half a point, 0.5, 0.6 area, and sort of bumping back up, even if it goes a little bit below that, because we have another, let's say, stock market sort of downturn and liquidity kind of dries up a little bit for an interim sort of period. I think the Fed has shown that it will be there. It will buy Treasury bonds, and that will, I think, create a scenario where rates may have seen their bottom for investors, which means that I think it's a good time right now for people financing, whether it's for residential up through commercial investment opportunities, or switching if they can, to kind of lock in those rates in this period. And in that respect, I think there's also opportunity, especially if you're looking at locking in, 10-year, 15, 30-year type of mortgage or financing situation. I also think that a lot of the servicers, sort of the in between people from the actual lenders and ultimately the investors or people buying residences, are going to be struggling for the very near term because of that lack of payment coming through to them. And some of them are on the margin. And so I think we'll see a consolidation in the servicer side coming in the next few months potentially, which also means that right now we have this sort of opportunity between low rates, servicers still kind of around, and people looking to lock in what they can from an investment standpoint and a rate standpoint. So I do see that kind of being the near term impact. Now, if we have another leg down, like really down in terms of the market, in terms of liquidity, and the Fed has to step back in, I think that we can reassess that, and people will. But I think right now there is sort of multi-month opportunity in the very near future to lock in investment or change properties.
Excellent. Now, you also mentioned jobs. Obviously, that's a critical factor as real estate investors decide which markets to go into, what products types to go into. We've seen upheaval in employment, but that also has been kind of industry specific, right? We were all talking about how we're busier than ever right now, but and we're blessed for that. There are people that aren't. There are industries that are going to take big hits, maybe long-term hits, maybe forever hits. So let's talk about jobs. What does it take coming out of that, and what are you seeing in terms of maybe midterm and long-term on the horizon for unemployment and the ability to get folks back to work?
Yeah, I mean, it is tough, and we are blessed that we can do a lot of what we do from home. And certainly millions of people can't do that. And I think what we're seeing right now is sort of the second leg of sort of the recent unemployment spike. We're going to see unemployment get much higher in the next quarter. We're going to see jobless claims continue to rise, perhaps rising more slowly because a lot of the main impact sort of happened in the first month or 5 weeks or so, that 30 million plus. That will rise incrementally, but perhaps not in the same amounts. So the question is, yes, what happens to people wanting to return to those jobs? And I think from the small business standpoint, a lot will depend on the liquidity they had, the loans they were able to get, and what kind of forgiveness they can get along the way. We know that 99% of restaurants are operating at 99% capacity on average throughout the country, and that's not going to be an area that's going to snap back. If we're looking at reopening the economy at potentially in certain places at 25% occupancy at most in some of these restaurants to maintain that safety, that's not going to be a situation where those people who are attached to those restaurants can potentially come back. Certainly in the next few months, perhaps in the next year. So I think that's going to be hard. I think on the other side, sort of retail positions, companies that are involved in sort of delivery processes or have been able to sort of rejig themselves to do that are actually hiring. I think from a technical platform standpoint, one of the reasons that the technical stocks, the tech stocks have kind of hung in there is because those do facilitate sort of both work at home as well as large scale sort of corporate environments, and so they have that ability to straddle. And I think they could be hiring. Like if I was just starting right now, as I was actually for the around the 1987 crash, way back out of college, I would be looking to be a computer programmer. I'd be looking to be in engineering, for infrastructure projects. I'd be looking to look at sort of renewable energy, natural gas type, sort of hybrid types of positions coming out or retooling myself, because I think in those areas there will be jobs. So I think it's going to look different. I don't think that all of those people, unfortunately, are going to go back to the jobs that they had. Some will. Again, it depends. But I think there are areas where there will be actually opportunities, and where, in fact, there is hiring. It will just take time for all those people, unfortunately, to come back into the workforce.
We often talk about this idea of recession-resistant pricing when you're picking a property. So the properties tend to do well in an up or down market. People have to live somewhere. Residential properties kind of below median. Well, there are certainly, as you're pointing out, industries and specific companies that are going to be more resistant to changes, and those that aren't. So love that perspective. But let's talk about, some of the new normal. If we see patterns changing, right? You're a gal that gets on a plane a lot. We've met each other in different places, and go to conferences and those things. Our travel, I'm 120 flight a year kind of guy, and that's all changed. So we are seeing some realities, but at the same time, it's also creating some efficiency. Companies are recognizing maybe they don't need quite as many folks, which is bad for the people, but maybe good for the businesses. What are some of the shifts? Because I know you look at a lot of different industries. Are there other shifts that we should be keeping our eye on?
Well, I think you're right in terms of those conferences, in terms of, sort of board meetings, in terms of any company is going to be looking at its bottom line now and saying, okay, well, this kind of worked out without us, sort of bringing people around the world or sort of sponsoring large scale things. And I think that's going to be a tweak that's going to happen across the entire international business community. And that's going to dampen some of the travel related businesses, but it's going to increase the value of the more technical businesses. And I think people are going to get more creative. And I think there's going to be sort of new developments in terms of what that means. Is that, easier forms of, I don't know, animating conferences, or are there areas in technology where you're going to be able to grab information and data and sort of more the ability to seem real? Where the businesses that can withstand that. And I think there's going to be some intelligent probably workarounds on that. I was watching, there's a lot of TV shows on that, but there's one in particular called Upload on Amazon, which if people haven't seen it, it's kind of cool. But it sort of looks at sort of future things without giving it away, but it's interesting. But the thing is, I think people will get creative with things like that. In terms of the real estate side of that, just to loop back into that though, what I'm hearing and seeing as I'm speaking to people I can't go to at the moment around the world in terms of the major cities is that there's kind of a rethink in terms of what a major city is going to look like in the next couple of years, and in terms of maybe being just outside the cities where people have lived or have had relatives or have had cheaper sort of lifestyles. And that could be for a corporate change as well as an individual residential change. There's kind of this idea of a pull from the cities, perhaps for a little bit in the next few years. Because if people aren't commuting as much, if people can connect more in, and if cities have more restrictions from what cities used to look like, just in the next couple of years, then there's more opportunity perhaps in outside of city types of areas to build businesses and to set down sort of real estate stakes.
Awesome. Love that. More food for thought. Now, before you were able to escape Wall Street, you spent a lot of years in the banking and finance industry, Chase Manhattan Bank and Bear Stearns, and you were with Goldman Sachs. And let's talk about how we see banking evolving from this. Are there going to be big changes? You've always had a lot to say about how the bankers work, and Collusion, your last book, amazing. What do you think? Is this going to make a dent? Is it going to make a change in the way that banking happens and the way that consumers interact with financial institutions?
Again, I think there's going to be a lot less personal interaction in terms of human to human. I think there's going to be a lot more in the places outside the city, a lot more efficiencies in the drive-through or outside of the bank physical operations. There's going to be a lot more online. There's going to be a lot more in terms of apps. Already right now, in terms of even loan applications, like everything is uploadable. You don't necessarily need to sit down with an individual in order to do things. And in banks, sort of mid-sized banks, they're actively going into those areas more quickly because they've had to in the very, in the past few weeks. And I think that'll continue to grow. In terms of how the big banks operate, they will continue to be the recipients of Federal Reserve help, subsidies, the purchasing of what's on their balance sheets in order to empty them out, to both provide them cash, to provide them liquidity, and allow them to lend again. And I think they're going to make choices to lend less to small people and small businesses, as they did out of the last financial crisis, even more so, and make more choices to lend to medium, larger businesses, which they have been doing anyway, but even more so. But I think ultimately they will be fine. They might get back to more of a reserve of cash than they had. They had a heavy reserve of cash right after the financial crisis, when the Fed started buying a lot of the treasuries and mortgage securities that were on their books. And that's happening again now. So I think it's going to take a little bit of time, but I think they're going to try to sort of hoard more cash again and make more specific decisions and more sort of conservative decisions as to who they lend to. Which again happened after the financial crisis of 2008. And I think we're going to see more of that now. But they themselves will be fine. They're going to be able to write down delinquencies and write down loans and get rid of their assets in basically an unlimited amount as necessary to the Federal Reserve. The Federal Reserve has already made that point. And so ultimately, the banks will be covered, and they will be fine on the other side of whatever the other side looks like from our situation right now.
Excellent. Well, we've already seen some of that in terms of lending, certainly commercial lending. More lenders are asking for more reserves, as you can imagine, right? Lenders are all about paying for whatever risk they perceive that they're taking. And so property collateral, those kinds of things. But it'll be interesting to watch, certainly as programs like that change. They changed last time we had a downturn, and they changed back as jobs were increasing and there was better occupancy in buildings and those kinds of things. Big picture, a couple of things we wanted to pick your brain on. There's been many years, most years that most of our listeners have been alive, that the dollar has been the reserve currency of the world. But of course, it's not always been like that. It's been a lot of attacks on the dollar, right? China, Russia, oil, the petrodollar. All this printing of dollars certainly is going to affect. We've seen the long-term 100-year trend of the dollar. What do you think the future for the dollar looks like? Can the dollar hang in there and still be the cleanest dirty shirt in the hamper?
So I'll say the same thing I've said after the financial crisis of '08 and throughout the years since, and I don't think it's that different now, which is that if you just look at the amount of debt the United States has, the amount of room and commitment that the Federal Reserve has to creating additional liquidity in the system or effectively diffusing the value of the dollar, you would think that the dollar has limited capacity to, be as much of a reserve currency as it's been since after World War II and so forth. But the reality is, in a period where there is extreme uncertainty, and in the aftermath of that period where there's been extreme uncertainty, it's because the dollar had been set up before that period to have that footprint, to be the majority reserve currency in the world, it tends to maintain it because we have emerging market countries throughout the world, for example, that have tremendous amounts of debt denominated in dollars, and now their currencies are depreciating because they are going through an even harder economic crisis in this whole global pandemic environment than the main countries are, because they can't afford to create as much of their currency because it devalues much more quickly. So it can't diffuse as much of their currency by buying as much of the bonds in their own countries and injecting as much liquidity as the Fed can in the United States or as the ECB can in some countries in Europe, although some countries are doing better than others, of course, in that regard. So what happens is the dollar actually retains in these crises periods a lot of its power simply as the currency of default. Throughout the world, it was there beforehand, and it's the default currency reserve, coming out of the other side of whatever this uncertainty period is, and we're not on that other side. So in math, it should not have the value that it has relative to other currencies, and as a percentage of the reserve currencies, reserve currency in the world, but in terms of behavior, and in terms of kind of having been there. It retains, and it will retain that value on the margin, even if other currencies, for example, the Chinese yuan and so forth, eat into global trade and sort of global currency status. That will also happen, but during these periods, everything contracts, and so the currency that was kind of there and biggest first retains that sort of momentum in the wake of these periods.
All right. Well, I knew you wouldn't let us down. Great input, Nomi. We're going to hear a little more from you when we're done in the lightning round, if you will. But thanks so much for sharing with us today.
Thank you so much for having me on.
Well, outstanding to get a chance to hear from banking insider Nomi Prins. She's been there, seen it, and she continues to watch what happens with the markets. Great to get her perspective.
Yeah, and I think it's sobering too, but not in a depressing way, because these are folks that have been inside, they've seen what goes on, they know that it's broken, they know in some cases it's wrong, even unethical or immoral, but at the end of the day, they see light at the end of the tunnel, they see a path through to navigate, or, we would all just curl up in a ball and quit, but we're not here to do that. And so it's refreshing. You do have to confront the brutal facts, and that's part of what this whole series is about, but you do it with the idea that you and your team, through your resourcefulness and resolve, can find a path to prosperity in spite of the things that are going on, and maybe to a degree because of the things that are going on.
So big thanks to Nomi Prins. In our next segment, segment 5, our series continues with another insider, Richard Duncan. He's an economist and author of The Dollar Crisis, but he's spent time in asset management companies, securities companies. He's also worked as a consultant for the IMF and with the World Bank. So coming up next, Richard Duncan.
Hey everyone, thanks for watching. Before you go, 3 things. Number 1, click the subscribe button, because when we have more subscribers, it makes it easier for us to attract better guests to share great content with you. Number 2 is click the notification bell to be sure that you're notified when we put up new content. This is obviously an ongoing situation. We're going to have continuous discussions about it. You're going to want to make sure that you're kept up to date. And then number 3 is make sure you share it. Tell a friend. Help us flatten the economic curve by getting more financial education out there to people who need it. Okay, so you know what to do. Click the subscribe button, click the notification bell, and we'll see you in the next video.
Systems break, and suddenly your family, friends, and neighbors are distracted with Wall Street stock indexes and Washington political pandering. Many are unaware and unprepared. Like COVID-19, ignorance of looming financial perils is also a disease, and the system is fragile. But you can help. Financial education is the vaccine. Share this free video series while there's still time. Alert people to these serious issues. If things turn quickly, the financial support system could be overwhelmed to the point of collapse. Help flatten the curve and reduce the impact on the financial system. Wake up more people to prepare. You have nothing to lose and a lot to gain. Share this video directly or invite people to visit crisisinvestingseries.com.